So I would like to welcome here our students and faculty of St. Peter University, from cybersecurity, from computer science, from the School of Business, our faculty from computer science and from the School of Business, our dean of the School of Business. I'd like also to welcome the faculty of Hudson Community College that are coming together to participate in this event, and the students of Hudson Community College, and many of them from their cybersecurity group, are coming to participate in this event. I would also like to welcome and introduce to you Ali Hassan, which is the CEO, and Chris Mata, which is a co-founder of Crescent Crypto Asset Management, and John Licata and Hunter Pendergast from MIR Blockchain Solutions. They will introduce themselves to you.
Hi everybody, my name is John Licata. I'm the Chief Marketing Officer of MIR Blockchain Solutions. It's fun to be back in this room. I was just telling one of the guys, back in 1991, I filled out my first registrar. I picked my classes when I came to St. Peter's for the first time. I'm a 1995 graduate, former soccer player for the university. It was called St. Peter's College when I first went here. I think they had black and white TV and indoor plumbing when I first came here. So it's amazing to be back. My background really quickly was focused on marketing, strategy, high-level communications. I was the CEO of Blue Phoenix, which was an energy research company for 13 years, a frequent guest on CNBC, in Bloomberg for north of 17 years. And my focus on cybersecurity, the evolving nature of digital infrastructure kind of collided several years back. So my focus on blockchain was an amazing area of interest for me. Became a big focus of Blue Phoenix. And as luck would have it, an amazing opportunity presented itself to join an infrastructure company. MIR is based in Atlanta, Georgia, really focused on the backbone of blockchain. So we'll get into some cool topics today and hopefully introduce some ideas for you guys to take away from. But it's wonderful to be back in Jersey City.
Hi everyone, I'm Christopher Mata. I'm the co-founder of Crescent Crypto Asset Management. Prior to founding Crescent, I worked at Goldman Sachs for 6 years. I was a vice president in the investment management division, specifically worked for the Goldman Sachs Philanthropy Fund, managing a multi-billion-dollar portfolio across multiple asset classes, which is how that was kind of my entryway into the cryptocurrency blockchain space, just getting involved in investing on the personal side, and that led Ali and I to launching our own cryptocurrency hedge fund, which has turned into a full-service digital asset management firm. So doing digital asset investment banking, advisory, consulting, research, and managing a portfolio of hedge funds.
Hey guys, good to be back, and it's good to see a lot of familiar faces. It's good to know that, unlike John, when I was here, everything looked the same. I was in this room not too long ago, also picking my classes, and we had lots of the proper plumbing, color TVs, good food. So times have changed, but what hasn't changed is the interest in new technologies and the passion that this university has for disruption. And the purpose of this conversation today and this talk is really not so much about us, but more to answer questions around blockchain and cryptocurrencies, which seems to me from my interactions with the students in the classes at this university is a topic of great interest. Chris gave our background. Mine is similar to his. I'm the co-founder of Crescent Crypto. Chris and I started this company to become a mainstream investment bank for the cryptocurrency ecosystem. Our background is in investment banking at Goldman Sachs. We took that background, those clients, those expertise that we had in that pedigree, transitioned it into a market, the blockchain market, that has very little pedigree and very little security around it, and we really built a company that does traditional investment banking, hedge fund management, and sell-side research. We'll get into all that later.
My name is Hunter Prendergast. I'm the CTO of Mimir Blockchain Solutions. I have a background in computer engineering, as well as nuclear reactor operations and solar systems engineering. So essentially ended up in the crypto space through connections to the Ethereum Foundation and a group of programmers that were associated that introduced the technology to me before the Ethereum mainnet had gone live. This was an immense benefit that afforded me an opportunity many people didn't have, to be able to pick the brains of some of the people who actually created the revolutionary technology that facilitates smart contract-based interactions, and ended up resulting in us forming Mimir Blockchain Solutions. As John has already said, we are a company focused on secure interactions and protocols that allow for better user interface, better user experience, as well as high-level APIs that abstract the complexities around dealing with this technology.
Yeah, so I think, as Ali mentioned, we're here for you. We're not here to sell either of our companies. We know each other very, very well, and it's been amazing that it was the St. Peter's connection that brought us together in the first place. But I think it's important to have some key takeaways. So right now, I mean, I'm going to just open up with some questions for the panel. Here in New York, the Attorney General's been talking about increased regulation. I know you guys have some thoughts about whether or not regulation is good for crypto. Maybe you could just give your thoughts on that, and whether or not you actually think that the cryptos are securities or commodities, so the students can better understand.
Yeah, no, it's a great question. It's one that's been very pertinent in the space in the past 3 months. I think you saw huge growth last year, and since then, the regulators are trying to catch up and figure out what the appropriate regulations are in the space. To answer one piece of your question, I think smart regulation is something that's beneficial. You've seen with the growth of a new emerging technology, unfortunately, you also have the growth of bad actors, especially in the lightly regulated marketplace. So you've seen a lot of fraudulent activity, you've seen a lot of pump and dump market manipulation. So these are the kinds of things that have kept institutional players on the sidelines up until this point. So I think regulators stepping in, figuring out which entities, which agencies in the government actually have jurisdiction over this market. There's been kind of this power struggle thus far. You have the SEC looking to regulate certain things, the CFTC looking to regulate certain things, and that comes back to your question on, are these securities or are these commodities? And I think we're trying to take a new asset class that kind of blurs the lines between all of these current classifications we have, and we're trying to fit them into these different boxes that are in place in the current regulatory infrastructure. And I think the bottom line is really that there are going to need to be some new regulatory guidelines put out to handle cryptocurrencies, because in some cases, some look like a security, some look like a commodity, and some actually have characteristics of both. In certain cases, you see in the ICO space, these pre-sales, which are securities, but then when you actually launch a viable platform and you have these, they can act more like a utility down the line. So I think these regulators are very attuned to this now and are trying to figure out the best way to handle this. But I think it's going to take some time, and hopefully they work slowly. Otherwise, you see severe reactions in the markets, as we've seen the past couple of months.
Before I get into that, John, is it alright if I ask the audience a question? How many people here actually own any cryptocurrency? And it's a good way to frame the conversation. So about half, which is really good, and you'd be surprised. This is a better reaction than when we asked NYU a very similar question. Maybe less than a quarter said. And who here does never want to own it, doesn't believe in it, will never touch those? Okay, good. It's good. The interesting point is, we usually see older gentlemen who say they don't want to touch it, and the younger guys who say they want it. But today, our hope is to explain this technology to you. And the main idea behind blockchain is actually very simple, and most people try to make it a lot more complex than it really is to sound smart. But blockchain is really a ledger, and a ledger is very simple. A ledger is what your bank does, what your accountants have. It's credits and debits, -1 + 1. What Satoshi Nakamoto did, who was the original inventor of the first application on the blockchain ledger, Bitcoin, he took that ledger and this very simple credits and debits and balances, and instead of centralizing it with a bank or a government or an entity, he gave that ledger to everyone. So Chris, John, Hunter, myself, all have this ledger, and every single time I want to do a transaction, where it was before the bank would do -$1 Ali, +$1 Chris Mata, make sure that I have the money, make sure that I'm not a drug dealer or money launderer, do all these checks to do all these services and protect us, and we pay them a lot for those services. But Satoshi Nakamoto did said, why don't we be our own bank on our own ledger? So now, on the Bitcoin blockchain, when I want to do a transaction with Chris, we would all look at our ledger. Every single one of us in this room would look, we'd say, does Ali have 1 Bitcoin? We would all agree that Ali does indeed have 1 Bitcoin. And then we would all write -1 Ali, +1 Chris. We confirm that I haven't double spent it. We confirm that I didn't get it in illicit ways. A lot of these things are actually traceable. And it's such a simple concept that eludes a lot of people. There's nothing too fancy about it. It's just a ledger, credits and debits. That was the first application via Bitcoin, and now we have multiple new applications. And I think we'll talk about some of the sexier things today around smart contracts and things of that nature.
Yeah, I want to pick up on a comment about this. This is really not new. Blockchain, the whole notion of blockchain is a fascinating one, but cryptography has been around for many years. So Hunter, why do you think that blockchain is being seen more mainstream by corporate America, and as well as a more decentralized community that's looking for all these creative applications for blockchain? I guess the question, really hone in on why now?
I think that the reason we're seeing this emerge in the enterprise market is because people have realized what the potential application of the underlying technology is. We deal with blockchain technology for cryptocurrency purposes, primarily in the world today. There's a lot of companies moving into this enterprise market, but the reason that we're seeing it happen now is because we've actually had enough of a longevity around the underlying technology that it was established that it is actually secure in some form or fashion and can be used for different forms of security than it was originally intended. There's very few places in the world where if you can break a piece of cryptography, you can immediately translate that into actual tangible gains in terms of real world value instantaneously. This is a system that has quite literally put some of the brightest minds in cryptography and in computer sciences against that concept and allows someone who is a malicious actor to actually directly translate their efforts into immediate gains. Considering that the Bitcoin network has been alive as long as it has, and the Ethereum network has been alive for several years and undergone several online dynamic attacks against its protocol and specifications, we're observing the fact that these technologies have emerged to a point that they've proven themselves, and so now industry is taking these concepts as potentially disruptive technologies that they need address. Otherwise, they may fall behind what could ultimately become another transformative event within the marketplace. That's my take, at least.
You know, the interesting thing about that is because, as you guys seen in Facebook, all the recent news they had related to privacy leaks. I mean, private data should be private, and I think people are trying to figure that out. How do we can benefit this? How can new applications emerge in this regard? And this is actually an interesting thing for Chris and Ali. So, from the investment side of the business, like you have ICOs, the initial coin offerings. Maybe you could talk a little bit about what's the benefit of doing an ICO versus just doing an IPO?
So the concept of IPO has been around forever. Companies get started, they get venture capital money, mostly from Silicon Valley and the likes. They build something great, they create clients, they create revenue, and then all of a sudden one day they decide that they're big enough that they want to take on public capital and subject themselves to all the proper rules of being a multinational corporation. That process is actually very expensive to go from a private company startup to an IPO. You hire bankers, you hire researchers, you hire accountants, lawyers. It can actually be a very heavy and fraught with friction transaction to do, and it subjects you to multiple layers of regulation that you may not be interested in subjecting your company to. What cryptocurrencies and the Ethereum network specifically have done is it has allowed these startups, companies like Hunter's and John's, to raise capital from the public in a way that is crowdsourced, that is friction-free, that is border agnostic. You can raise capital from anyone in the world at any time, and in a way that is trackable and traceable and open for everyone. It lets anyone, whether you're in Silicon Valley or India or Pakistan or Ukraine or Africa, doesn't matter where you are, if you have a great idea and you have access to the internet, that's really the only necessity. You can raise capital from the entire world and go out and build a great solution. That source of capital and that ability to monetize a specific project or revenue stream at those levels, at those micro levels, has been impossible for the majority of the world for history, as I know at least. So this is a concept that commoditizes and democratizes the ability for us to raise capital as companies.
Yeah, and I think just to add, you've seen less and less IPOs over the last 10 years, right? It's become more and more challenging to launch a successful IPO. It's much more expensive than it was in the past. You pay these investment banks like Goldman Sachs, Citibank, JP Morgan, billions or huge percentages of your actual raise, which makes it just very costly for a smaller company to try and do that. To Ali's point, you really reduce the friction by using something like a coin offering, where you don't necessarily need an investment bank to raise this capital. Some people still use it, and there are still regulatory complexities, so it's not completely frictionless. It was originally, but regulators are starting to catch up. But it's still a much easier way for entities to access capital from thousands of individuals around the world, with maybe much less expenses than doing a full-blown IPO.
And so to take this concept outside of simple capital raises, this concept can be generalized in the sense that what one of the promises is that blockchain is trying to achieve and realize is the ability to disintermediate markets. The idea that if you have this immutable trusted system that allows for third-party authenticity and integrity, verification, all of those really cool cryptographic and security concepts, what you can do is you can have direct consumer-producer models. We've observed this within the crowdsourcing of funding, but you also have companies that are attempting to provide the same types of interactions for things like file storage, computational resources, as well as a number of other underlying products. And so if we take what they're speaking to and generalize it back, that's why a lot of people have become so excited about this technology, is the idea that we can create more efficient markets by directly connecting the people who have a resource with the people who have the value that can pay for that resource that they're trying to sell.
Yeah, and I think in the capital raising example, to the Hunter's point, the tangible, actual example of that is you don't need a broker-dealer like Goldman Sachs. You don't need an exchange, a centralized exchange like the New York Stock Exchange to actually trade these coins. There are decentralized outlets where you can essentially trade these tokens that you issue as part of your equity structure for your own small company. So those are two easy examples to see that disintermediation in action.
And I guess it's speaking in action. So fintech does have an amazing opportunity to be more efficient thanks to blockchain technology. But there's also other areas that we're seeing great opportunities for disruption. It's more complicated, but augmented reality, the Internet of Things, healthcare, automotive. I mean, if you think about the car of the future, car sharing, insurance, things that can be personalized and have that middleman kind of whittled down. We're seeing a lot of interesting ideas come to the marketplace, and I will tell you, as the CMO up here, it's stuff that, it's as great as it sounds, it's also extremely complicated. And when we talk about things, there's such an educational component that needs to be discussed. It's something that needs to be established. One of the things I'm proud that both teams up here is really working towards is credibility, and I think that's something that the industry needs more of. So when you're looking at projects in the space or have ideas about what applications may come, not just look at the viability, but look at the credibility of the team behind those applications. Just want to shift gears for a second and get into mining, and I think this has implications for everyone up here to give their input on. But for those not familiar with the concept, maybe Hunter, maybe you could start us off, give us a high-level view about mining, and where do you think it's going?
So within blockchain networks, one of the things that you have to be able to do is control the transition of state. This means that the same way in a computer there's a clock, and you only change things when the clock says, hey, it's time to change again. So trying to keep this very high level. But the idea is that a blockchain also needs this clock of a sort, something that allows everyone in the world to know officially when a change has occurred in the system, and for them to all come to an agreement that the change that has occurred is not in violation of the fundamental rules of the system. Mining was the original strategy that was devised to provide this mechanism, and what was actually being done was there was a set of computation that these individuals that were mining that performed, and it's essentially garbage computation. It doesn't have any intrinsic value other than it has a very easily measured likely interval of time it took you to find this given answer, and so you can slow the system down to the speed at which you want this clock to occur. And this is the process of mining. You basically buy a computer and you solve this big computational problem, and if you solve it first, then you are rewarded in the underlying asset for solving this problem because you are providing the security of the system. And we can get into a lot of the technical details as to how that operates, but that's probably outside the scope of what we're discussing here. Now, the problem with traditional mining is that it operates under this wasted computation. The goal of many different organizations is to find more efficient mechanisms that don't waste a ton of electricity and don't have all of the problems of essentially Moore's law, i.e. as computing power increases, the value of your current hardware decreases. So you're constantly having to buy new hardware. The next step that is the major play is into what we call proof of stake. This is a system in which the security is established inside of a system by essentially creating game theory such that if a person was to attempt to manipulate the operation of the system, they would be destroying their own value, and they need necessarily have sufficient invested value in that asset that it wouldn't be worth their interest to manipulate data. This is very technical and complex, but the idea here is that we're moving away from wasted computation and we're trying to get into more efficient, optimal algorithms that do allow for distributed consensus to be achieved so that we can increase how many transactions per second these networks and this technology is capable of processing.
Yeah, I think that was a perfect explanation. I think to even take it higher level, the whole point is you have this distributed ledger, right? And you need everyone to be agreeing at the same time on what transactions happened in what order in order to make sure that this network is secure. That's the whole challenge with the distributed ledger. Like Ali mentioned, you have thousands of people around the world with this same ledger that have the same transactions on it, and everyone has to agree simultaneously that these are the transactions, this is the order, this is how much everyone has in order to prevent what's called double spending, right? I can't send one Bitcoin to Ali and then send that same one Bitcoin to Hunter. So those algorithms that Hunter's describing are different mechanisms in order to ensure that people are putting resources into the system and have that grounding where they have skin in the game. In proof of work, you're putting in real-world power, where you're paying for real-world electricity to run these computations and the hardware. And in proof of stake, you have an economic component where you're putting up your own, you're staking your own coins on that network, which can be burned away if you're a bad actor.
Yeah, and I would say that to the last point about proof of stake. So for those that don't know the differential, so proof of work and proof of stake. So the Ethereum Foundation is moving to a Casper protocol, which is going to be proof of stake. Time frame, Hunter, probably.
I just listened to Vlad actually speak on his technical analysis of this, and he was saying that within the next year he believes that they'll be ready for full production launch. So measured small incremental approaches to improvement. If you get it wrong, you lose a lot of money for a lot of people in the world. So they're trying to be careful and go slow, but I think within the next year we'll see what's called the Casper implementation of proof of stake go live.
So incremental improvement. I guess we could have had a panel today just talking about opportunities in blockchain. I guess we respectively see that from a different lens, us being more focused on infrastructure, and then from the financial strategy and asset management side that Crescent takes. But I think that would be kind of interesting to broaden the conversation a little bit, and rather than just focusing on just about the opportunities, is maybe we can all just kind of dive in a little bit about the challenges that we also see, because I think we all can add a little different flavor on that. I mentioned earlier about the education and clarity issues that I'm dealing with, being on the marketing side of it, but certainly we'll open it up to the panel.
So there's this beauty of being decentralized and not having to rely on banks and not having to pay them the wiring fees and the ATM fees and the credit card fees. Banks do a lot of work. They actually secure your money. They make sure that if you were to get hacked or if you were to get robbed, you are federally insured, you can potentially make some of that money back. When you're dealing with cryptocurrencies and you've disintermediated these banks or these toll collectors, you essentially have to become your own bank. Yeah, you're no longer paying the same fees, but you don't have the same protection. So one of the challenges that keeps a lot of people on the sideline is they are afraid that they're going to lose their money. They're afraid that they're going to get hacked. We have to be careful when we talk about Bitcoin getting hacked. The Bitcoin network has never been hacked. The protocol, the algorithm itself is encrypted in a way that makes it impossible for someone to just change the ledger on my computer. You would have to change over half of the ledgers that everyone has. So for someone to steal my or your Bitcoin, they're essentially getting something called your private keys. They're usually phishing, getting access to your phone, your computer, your accounts, and stealing your Bitcoins, not breaking the algorithm, not breaking the protocol and saying you don't have those Bitcoins, those are not mine. That's a big concern, obviously, because now we are subjecting ourselves to our own mistakes and our own issues where if you lose your password to your bank account, your bank can reset it for you. You can potentially get your money back. If you lose your private keys, or if someone gets access to your private keys and they take your Bitcoins or other cryptocurrencies, those are gone forever. The beauty of cryptocurrencies is immutable. It cannot be changed, so once something bad happens, it goes away. And I think that's a big challenge for a lot of people to comprehend and wrap their head around that. You could essentially be wiped out because you don't have those same protections afforded to you from paying those intermediaries.
Word to the wise, keep your private keys private.
Yeah, I think just to add a couple things. One, we touched on the regulatory environment, which is definitely another challenge to the space, but something I'm sure Hunter can dive in a little deeper is also just on scalability. We talked about the challenge of actually operating a distributed ledger, right? You have thousands of people that are trying to all coordinate these transactions. That is an actual scalability nightmare, right? In order to get transactions per second to equate to something like Visa or MasterCard, who literally run thousands and thousands and millions of transactions a day, these blockchains have to have newer, better technology than what's currently implemented at this stage with proof of work and the current proof of stake algorithms, which can, today, Bitcoin, for example, processes, I think it's something like 2,000 transactions every 10 minutes, I think is one block, which is obviously very slow relative to what these big banks and credit card providers can actually have in terms of flow through.
So a few points here. The first being, in terms of the ability to recover lost funds and everything else, this goes back to a fundamental technical difficulty that is afforded by banks that's not afforded by blockchain technology at this point, and that is that you contain in the physical world a unique identity that is provable outside of just ones and zeros. Within blockchains, you are a public or private key respectively, or an address, and that's the only identity that we have for you. And this is where a lot of these problems stem from. So one of the big problems a lot of people are working on is how do we establish identity-based systems inside of blockchain technology. Very promising future tech. The other point that I wanted to bring up was the regulatory compliance issues. There is, as we've said a couple times through the course of this, increasing complexity around dealing with these technologies in the regulatory space, and this is referred to sometimes as the gentrification of the blockchain blockchain, or gentrification of the token sale, or ICO. It is a reality, but I think that it's a necessary reality that actually brings better stability to the system so that you can actually protect your underlying asset, and hopefully it will result that we'll have a more stable asset that can be used for secure store of value in perpetuity. Now, all of that being said, to go into the last piece regarding scalability, this is a real problem. So the Bitcoin network processes approximately 10 transactions per second. The Ethereum network, I believe, is around 20 transactions per second peak. There are other chains that can process hundreds, some of them claim into the thousands, using different mechanisms, but there's no such thing as a free lunch. So what often you see is that these technologies that are attempting to increase their capability of doing more computation, handling more work, what they're actually doing is they are removing elements of the decentralized model on which they lie in order to facilitate some form of central coordination. This makes it much easier to increase the throughput of a system because you don't have to essentially wait on the amount of time that it takes for messages to travel around the entire world. You're limited by the network latency of the internet itself. Unfortunately, many people think this is an unacceptable compromise because the ideal world for many of the hardliners in the blockchain space, especially in the cryptocurrency world, are that all systems should be fully decentralized and democratized. There is some measure of compromise here where in different applications there's different measures of centralization that may or may not be necessary. There's also some very interesting projects that are trying to solve this in a decentralized way. So one of these projects, I actually just flew in from Colorado, and I had the benefit of sitting down with the core development team, was Archain. Within the Bitcoin network and the Ethereum network, these processes are purely synchronous, meaning that they flow one instruction at a time, always in ordering. Within the Archain network, what they're attempting to do is essentially parallelize computation. So in the same way that your computer used to have one microprocessor and you can only do one thing at a time, they are essentially trying to leverage parallel computing architecture into blockchain technology to increase the throughput. It comes with an incredible amount of complexity, and they're still working through some of the finer technical details, but there are a lot of teams that are trying to get the throughput to be equivalent to what is approximately 20 to 30,000 transactions per second that Visa processes every day. And in the event that someone actually pulls this off, and that they find a mechanism to have a stable form for the underlying asset, then you have a technology that allows the process to disintermediate payment processing, which means that we can have less money wasted on simply exchanging value between two individuals, and therefore ultimately more efficient marketplaces, better for end consumers, better for businesses, potentially bad for people like Visa. But this is really exciting, and like I said though, there's still a lot of little details that have to be figured out before we can do that scale of change.
So before we open up to questions, I know we're short on time and we want to hear from you. I just wanted to ask the panel if they would maybe just give their quick thoughts on what professions do you think are going to come out of this new paradigm we're in right now with crypto and blockchain, and is there any readings or areas of that those in attendance would maybe find valuable post this conversation to learn more about these fun topics that we're talking about?
So there are immense opportunities for those who are interested. The easiest ones are around blockchain development. So anyone with any development skills or interest in coding, I would recommend, if you can, get access to a mentor, figure out how to develop smart contracts, write in some of these new protocols and these new languages that a lot of these creators and these DApp platforms are creating. It is an immensely massive opportunity. There are not enough people in the space, and just as a function of supply and demand, the kind of revenue one can generate from learning these skills when there's such a demand for them is unreal. On the more esoteric side, on the investment side, there is still huge potential value from investing in the space. There are a lot of people our age, younger people who have perhaps never invested in a stock. maybe never bought a bond, might not be interested in commodities or futures, but are interested in Bitcoin and Ethereum, Litecoin, want to participate in these ecosystems. We are still at the very early stages of the entire ecosystem. And for those that can afford to take a smaller risk and enter the space and want to enter into the investment space, there's no better way to do it than to build a track record and start investing on your own. Start looking at protocols that you want to participate in, reach out to developers, put together your reports, do some research, and to the final question on what you can read and how to really understand the space and dig in deeper if you are interested. There are a number of really good newsletters out there. My firm actually, we put out a newsletter, it's a free newsletter that goes out every week, a macroeconomic piece called Crescent Talks Crypto. You can subscribe right on our website. It's a pretty in-depth piece, and if you read that often enough, you start to see who's operating in the space. Get on Twitter, follow some of the more prominent names on Twitter, and if you need those names or are interested in learning more, just reach out to me. Make sure that your LinkedIn is up to date. Show the things that you're interested in. Write about what you are investing in. Constantly let the world know that you're interested in this space, and before you know it, you will be entrenched in it. The opportunities are massive, and they're waiting for young people like yourselves to come in and really do something interesting.
So I'm going to take actually a bit of an opposite perspective. There's obviously a lot of potential jobs that can be fulfilled in this space. The thing that I would say, and this speaks to the computer science majors in the room, the people who are programmers, and also the people who are moving out into the workforce after they finish their education. The thing that a lot of people don't really discuss about blockchains and what they fundamentally are is they're a permission access management scheme at the end of the day. We have this big database that only a privileged user can modify the data on, and that anyone can read in the entire world, which means that a lot of jobs in the marketplace that are essentially administrative gatekeepers to the modification of public record or other data are potentially at risk because of this underlying technology. This allows individuals to own their own data and to administer rights against their own data in a secure manner. And this is going to be one of the transformative opportunities that should emerge out of it. So if you can look at the world and see an inefficient operation around a workflow associated with personal information or the ability to modify public record, and that you wanted to make it more efficient and programmatic, that is a golden opportunity moving forward for something that needs to be solved. And there's a lot of people working on it, but nobody's exactly figured out all the details yet. So just a place to look.
Yeah, I mean, and I wanted everyone to know too that there are opportunities that, whether you're a business major, an economics major, a marketing major. I mean, I was an economics and marketing major at this school, and so my path was a little bit different than the rest of the folks on the panel. But there's a lot of opportunities to create education, awareness, to drive public relations. It's not just about the computer science. I mean, that's an amazing opportunity. But definitely know that there's a huge need to fill the voids that we're seeing right now. I'll go back to the word clarity. So, those who enjoy writing, there's a great need to help fulfill the transparency gap from taking very high subject level matter and to put it into layman's terms for people to understand. I would say, actually, before we came up here to join the panel, I was complimenting Ali on the newsletter that they put out. I would highly encourage people to take a look at the work that they're doing on a weekly basis. It's not just about letting people know what's happening in the world, but kind of breaking down the significance of why it's important. I would also point you to look at areas like the Ethereum GitHub, look at the wiki. I think that's really great ways that Hunter pointed me to when we first started. And that's something that we continue to navigate. So of course, social media, there's great opportunities to learn. If those are interested, our Telegram is starting to grow. It's Mimir Blockchain. You can speak with us. We're very reachable. And I would encourage those in the space that if you see something that could be a disruptive nature, go for it. We do, and it's something that motivates us on a daily basis to try to change the world, for lack of better words. but we feel like there's things that need to be changed. So I'll leave it there, and I guess at this point, we want to hear from you guys. Are there any questions that we might be able to help you better understand?
What's the difference between a utility and a security token?
Sure. So I think the main difference some of it is a regulatory, it comes back to the regulatory concerns in the space, but a utility token in essence is kind of like a commodity, and really what that means is there's a platform that's established where this token has a specific function on this platform. It's not necessarily an investment per se. It's more you can take this token and use it. So you can, a simple example is maybe Amazon Prime, right? Or Amazon.com. If they launch their own token, the Amazon token, right? You could use that token to purchase Prime services. You can use it to actually purchase things on their website. It has a fundamental utility to you buying that token. It's not necessarily an investment vehicle. On the other hand, a security token is more you're purchasing it because you see upside in this token and you may get equitable ownership in a company, right? So a security token, if Crescent launched our own token, the Crescent token, you might own 5% of the company by owning a large share of these tokens. So a utility token doesn't give you any sort of ownership or equity or revenue share in a company, while a security token may actually do that.
What sort of projects are you guys looking to in the future to take part of in like the growing, I guess, blockchain science?
Could you just repeat that a little louder, please?
Yeah, what projects are you guys planning on participating in the future? Because there are so many different things in
Sure.
blockchain. So like there's identity, security, so on.
Yeah, so I can tell you that we were invited recently to the Pentagon to explore how blockchain can be useful for natural disaster relief. Clearly, how funds are allocated is a flawed topic. Red Cross is challenged right now. When you give money to the Red Cross, you don't know where it goes. It's not going to the right person. And that's one area that we see that's really intriguing. Again, healthcare, digital identity preservation is paramount. Earlier I mentioned the automotive world, specific projects are relating to the autonomous vehicle. And with digital twin identity, things that are being pushed forward by the likes of General Electric, they're trying to incorporate how that can play a role in the future car. So if the four of us are have an insurance program, well, why should I pay more for my insurance if I'm driving a hell of a lot less than Chris and Ali and Hunter? So the insurance is actually really been very proactive about trying to be an advocate for change when it comes to blockchain.
Hi, is cryptocurrency the best way that blockchain can serve the financial industry, or is it more of a kind of a petri dish where we get to examine how this technology works and might better serve the business world and others?
It depends very much on what your, I guess, belief in the end resultant is. If you think that you could build a disintermediated financial system that needed essentially not as much or diminished centralized control and authority, then there is potential that cryptocurrencies could play a primary role. Now, that being said, the ability for governments to control their own money supply, as well as interest rates and everything else, are necessary for the functioning of modern societies. So I don't think that this is a transformation that is likely to occur in the near future. What I think is that we're going to see some mix of both. I think that in certain marketplaces in the world, we've seen hyperinflation because of the government's essentially overprinting money, and you see that in these different economies that people are adopting this technology as a form of financial exchange because the primary form isn't actually as stable as even the cryptocurrency markets. So I think that you're going to have first adopters in these circumstances where the incentives or the value proposition is great. I think that within the luxuries that we're afforded here within the first world, it's going to be very much a different thing. The other piece of this is that there is a massive set of implications within the enterprise world, and I can speak directly to the fact that within our company, we're building a set of infrastructure tools that are leveraged, or may be leveraged in both the public and enterprise worlds, because we think that it is our best bet to hedge risks and play both. So I think that at the end of the day, there's a set of fundamental problems that the blockchain technology solve very well, and that we're going to see them adopted wherever the value proposition is. Sometimes that's cryptocurrency, sometimes it's not. I know that's a very vague answer, but at least it kind of gives you some perspective as the way that I approach thinking about that problem.
And before we take the next question, back to the question about the current use cases, I just wanted to let you know that Walmart and IBM just recently were able to tap blockchain to create food safety at a very core, finding out a problem that would have taken months for blockchain to actually figured out where the issue was in hours. So there's the practical examples are starting to really come to mainstream markets.
Can I ask how you think this is going to disrupt social media? Are we going to own our own data and instead of Facebook owning it, for example?
Yeah, that's a great question. There are platforms out there trying to do and solve for this very particular problem, and not just with social media, anything from where our data is monetized without us knowing or without us participating. This is prime disruption for the blockchain. There are projects like Steemit and others in the space that actually incentivize the users to, by owning the coins or by owning these tokens and participating in the network, you actually get to participate in the revenue that is generated off of your post. The advertisements that the network collects get paid out to those that participate in the network. So yeah, I do believe that this is going to be a game changer for social media and any other company or service that uses our data for their own benefit without sharing that benefit with the end users. So when you think about it, Facebook doesn't really have a product. We are the product. We get this service for free, but we're the product. They monetize us. Cryptocurrencies or blockchain specifically will allow us to take back a piece of that monetization should we choose.
Yeah, I think one piece to add there is there are definitely use cases where that can happen and that it's going to be implemented where there's different ad revenue schemes and people are able to monetize their own data. But I also think it's kind of a blue sky vision in some ways. I don't think there are projects that are trying to be the decentralized Twitter and the decentralized Facebook. But I think the issue is that a huge benefit to having the Facebook as it is today is one, the network effect, obviously. And two, you have these great user interfaces and things that are actually hugely beneficial, which are difficult to build. And these decentralized platforms are coming up short. The only thing they're really offering that's different from something like a Facebook, they're trying to copy it with a worse interface and simply saying that, oh, it's decentralized, so your data isn't going to be consumed. And people say that they care about their data privacy, but unfortunately their actions don't generally mirror that belief. So after the Cambridge Analytica, after Snowden, all of these things that keep happening, maybe it's building to something, but in a lot of cases, people don't actually change their actions. They like the targeting advertising. They like a lot of the benefits that you get from giving away your data in a sense. So I think maybe some middle ground will come out of this, but I'm not necessarily sure that you're just going to see a decentralized Facebook suddenly take over what Facebook has currently built.
And I would just add to that point, Chris mentioned user experience, and I think that's huge. That's something that we see as if blockchain is truly going to become mainstream and be a technology across many industries, it has to be easy. This is too complicated of a subject matter for the average person to clearly understand the way, they don't need to. So we often use the analogy of the Netscape moment. Blockchain needs a Netscape moment. That's not just for social media, that's across blockchain. And if you think about it, what Netscape allowed the first millions of people to access the internet. But it's basically an invisible technology. You go on a browser, you don't really, you don't need to know about the connectivity issues behind it that allow that to happen. Blockchain needs to become invisible, and if it does, never mind social media, the upside could be tremendous.
You see cryptocurrencies going away?
Absolutely not. Do you guys want to answer that?
I mean, I would challenge to you, what do you even mean by that? How could they go away? You cannot run this decentralized ledger without incentivizing someone to host it. So how can you run a ledger where it's decentralized and you need multiple people to contribute their computational power and maintain this ledger in an efficient way without having anything to incentivize them? So to answer your question, no, I don't see cryptocurrencies going away. The opposite end of that, I think the word cryptocurrency doesn't always make sense. They're not currencies. Most of them, if not almost all of them, have nothing to do with currency. So we like to use the term digital assets. Most of them are have a very particular use case or a very particular reason they exist, and it is not for transacting or buying things. They solve a particular problem or disintermediate a particular function.
Gentleman in the back.
Can you guys just kind of cover some of the similarities and differences between blockchain and Tangle as used by IOTA?
Blockchains essentially, as I was talking about earlier, move in essentially measured ticks. You know, that's why you say blocks. So this state transition occurs, and then the next one occurs, and then the next one occurs, and so you always have what we call convergence to atomic truth. The idea that we know what state the system is very easily. Within the hash graph model, what you actually have is a system that has a very slow asymptotic approach, if that makes sense. Basically, we never are absolutely certain about what the state of the system is because there's no clock essentially kind of saying this is the change. Those technologies have incredible utility for different applications. Personally, I'm hesitant to use them for entirely public systems that rely on them as a pure security model. I think that they operate very well in different environments, but you have to measure risk and you have to understand, I guess, without getting into the really technical detail about it, it's hard to kind of describe the cost-benefit analysis, because like I said earlier, there's always a trade-off. And if you would like to talk about that after, if you want to get into the technical details, I'd be happy to explain, but at least that's kind of a general overview approach, is the uncertainty of the system is greater.
Okay, how are we doing for time, Professor? Do we have time for one last question?
So I think most people here would agree that some regulation, smart regulation, would benefit the entire market. But with any type of regulation, even minor regulation, the markets kind of react in a bad way. This is kind of a question for Crescent Crypto. How do you guys plan on protecting your clients and stuff from another crasher, so to say?
That's a really good question, and it's one we come across often with our investors. We actually take a very interesting view. We think regulation is good, and even though it might cause some short-term speculation or cause some bounces to the bottom, we believe that there is enough capital waiting on the sideline, enough institutional money waiting for true, proper regulation, true investor protections, that is going to be a benefit for the entirety of everyone who's invested. The market, no one here would argue that we like pump and dumps, that we like scams and schemes where people raise money and then disappear. When the market kicks out those bad actors and the regulation comes in, and we see a flight of good, strong assets, we're most often going to see that those who are originally invested, the ones who had the first ones to invest the capital with us or on their own, will benefit the most, because these assets are commoditized. There's a finite amount of them, and if new investors are coming in and need to purchase these assets, they're going to benefit you because you held them before they came in.
Okay, well, thank you very much for participating, and we are going to close the event now. And I ask for a round of applause for our
I was like, never, not gonna move.